All right. Should we get started? Great. So welcome back, everybody. Before I introduce our speaker, I just wanted to point out for those of you who are attending most of these that next week we're taking a week off. We'll be back on February 17th when Casper de Jong will be speaking about why insurers know more about us than we know about ourselves and what difference that makes and for how markets work. So today our speaker is Justin Sydnor, joining us from the Business School at the University of Wisconsin in Madison, where he is the Leslie P. Schultz Professor in Risk Management and Insurance. His work draws on behavioral economics, on psychology, and empirical data to illuminate how insurance markets work or don't in practice. And an important strand in his writing concerns the complex issues that are raised by people's ability to choose their own deductibles, what that means and how it can work well or in many cases very badly. He's going to be talking today about deductibles in health insurance. If we're lucky, we might also be able to persuade him to talk a little bit about some of his prior work, including I guess my personal favorite among his papers, which is what it is about the relative length of your second digit and fourth digit that predicts how risk averse you are and the kinds of choices you're likely to make. It seems to be that it actually is predictive, so everyone stare at their fingers and take a look. You can assess for yourself. Anyway, please join me in welcoming Justin Sydnor to the New Ideas in Insurance series. Thanks, Justin.
Great. Well, thank you, everybody. I'm really impressed to see the great turnout for this. This is a really neat series. So I appreciate you all for putting it on and for attending. So today I want to talk to you a little bit about sort of a compilation of some of the papers I've worked on and also some things some others have worked on around health insurance choices. And I think kind of the best way to start it off is to actually get you all thinking a little bit about a situation that kind of motivated some of my work. So what I want you to imagine is suppose, it's benefit choice time and your employer uh, says, all right, this year we're going to have 4 plans you can choose from. And you can see them here on the screen, A, B, C, and D. And all of these plans are going to give you the same network of doctors and hospitals. So, it's the same insurance plan, same, wrapping. You're going to have the same sort of insurance card, same access. So it's not a question of like which doctors you can see. We're just giving you 4 different options of the financial features, different premiums with different deductibles and spending limits. Um, so you can see these 4 options here on the page. So you can see there's a $250, $500, $750, and $1,000 deductible. I'd like everybody take a minute, look at this, and try to decide if this were the set of options you were given from your employer, what would you choose? Pause here for a second so everybody can think. All right. So we're not on Zoom, but so I was going to say, why don't we just have everybody real quick in the chat, if you will, just quick type a letter. Which one would you choose? I see Daniel started it off. He would choose D. Now let's not all just necessarily pool on Daniel. He may or may not have a good choice for us, but let's see what we choose. Okay, so I got some A's, some D's. Okay, C going on in there. All right. Okay, so I think we've seen kind of enough. Let's see a B going on there. There's kind of a mix, right? So some of us would choose A, some of us would choose D. Few people would choose B or C. Now, it turns out this is actually a menu of options from a company where a number of years ago in one of my earlier papers, we got data and we studied what happened when this company started giving people choices that looked something like this. And I'll talk maybe a little bit more about the details in a bit. But what I want to highlight here is that if you're enough of a sort of insurance economist nerd and you start breaking this down, what you'll actually see, and it's not obvious ahead of time, is that option D actually financially dominates the other options. What do I mean by financially dominates? What I mean in terms of total amount of money you might spend for the year, you're going to spend less with option D, regardless of how much healthcare you might need. Now, that might sound surprising at first, right? So you look at this table and you're like, well, but suppose I'm a really sick person. If I'm a really sick person, I'm going to end up hitting that higher out-of-pocket max. And you can see option D has, for instance, a $3,500 out-of-pocket maximum. And so if I'm going to pay $3,500 out of pocket, wouldn't I rather have one of these other options where I pay less? But the key thing when you look at this is if you also compare the premium differentials, the amount you're paying for sure, are large enough that they overcome that additional spending benefit you'd get from having this having a lower deductible. So for instance, let's compare B and D. It turns out at the company we were studying, a lot of people chose B. Um, Here we had a lot of people choose A, but I think the math is just slightly easier to see on B. So if we look at B, what you can see is that you would save $500 in the deductible, meaning if you sort of just had kind of one large expenditure, you might save about $500 in out-of-pocket costs with B. Or if you have tons, if you need to go to the hospital for a lot or you have a really bad illness, you're going to hit these maximum out of pockets and you'd have $500 less for B. So B basically offers you potentially $500 more worth of coverage, but you pay $600 more for this. Okay. Now, we've got enough lawyers and others in the room to recognize that, yeah, but there's some tax differential treatment around premiums and out-of-pocket costs. And so, technically this might overstate it a little because I can pay those premiums with pre-tax dollars and I might have to pay my out-of-pocket costs with post-tax dollars. But it turns out that, for most people, that's not going to be enough to change this calculus. And in a lot of cases, for instance, when there's true high deductible plans, the out-of-pocket spending can also be pre-tax dollars with those high deductible plans pretty easily. So, the basic thing is you're paying $600 more for potentially $500 worth of coverage. And if you end up not going to the hospital at all, if you don't use any coverage, you're just going to get that $600 for sure in savings. Okay. Now, so we could draw some graphs to show this, but I think probably did I convince you roughly of how that works? Okay, I at least a couple of head nods there. So this basic phenomenon of like an employer, and that was a menu from a large employer, Fortune 500, actually a Fortune 100 company, gave their employees that set of options. And what I want to talk about today is kind of dissecting this phenomenon of dominated options, like what I just showed you, where there's, an option that for sure you're going to spend less with one of these options, meaning for sure you'll spend more if you choose one of those other ones. Or kind of more generally, we might also think about sort of a more general thing that there's going to be a lot of cases where maybe it's not quite so stark, but where some options in health insurance are sort of low value in the sense that for a broad range of spending you might have, you're going to end up financially paying more for one of these options than another. Um, so there's a set of questions I thought we'd try to run through today. First, does this situation happen in reality? Well, I've already kind of told you I have at least one example. But more generally, is it common? Second, do people really end up choosing those dominate options at high rates? So, for you all, I gave you, 30 seconds and not a lot of incentive to really think very hard about this. It might be that the vast majority of people actually find their way to those financially dominant options when it's real money on the line. To the extent that people do choose the dominated options, can we figure out who it is? And can we say anything about why they do that? What's driving choices? Um, and then I think maybe the most interesting conversation possibly for today is why would employers have health insurance options with dominated or low value options? Like why are these on the menu? If nobody benefits from it financially, why is it being offered? And I'm going to give some thoughts about, some potential reasons and kind of what I think is maybe the dominant story of what's going on. And then in the last part, I want to talk a little bit about, well, what could we do with this? Like, what are the implications potentially for how we might think about regulation or potentially the value of decision aids? Okay, so that's where I want to go. I can pause here for a second in case anybody has any questions before we really launch into it in depth. All right, okay, okay. So, is this common? And the short answer I'm going to give you is yes. And I'm going to give this, now I don't want to overstate that yes. By common, I don't mean to say that the vast majority of people are in a situation where they have a dominant option, but it's not a rare thing by any means. And so I'll give you kind of highlights from a few studies here. So first, this was first something that I started to notice for health insurance anyway. There was a study in 2013 by Ben Handel, who was studying health insurance at a large employer. And he was really interested in the idea of inertia, the fact that when people make a selection, they tend not to switch. And what he observed at this large employer he had data for was that there were some plans that initially a bunch of people selected into, and over time the price of those plans rose a lot to the point where for some people they became dominated. There were options they could switch to that they would for sure save money with. Um, but he noticed that very few people switched. Okay, and his story was largely a story about sort of a lack of attention and this kind of inertia. Well, then in 2017, in a paper with Bargava and Lowenstein, we got access to data from this company I started telling you about. So we had a Fortune 500 company. And what they did is that they went from a scenario where they used to offer like 3 different fully insured health insurance plans uh, to a world where they became self-insured, and they kind of had this debate internally about, well, how should we design our plan? And they worked with some consultants, and the health consultants sort of said, well, you can set up actually a very flexible menu where we can design something that they called build your own for the employees, where basically they just gave the employees a menu. There were 4 deductibles that I just showed you on that prior screen. There were 2 different copay rates, for things like, a doctor's visit, 2 different co-insurance rates. So what share of the bill do you have to pay once you've hit the deductible for the year and before you hit the maximum out of pocket, and 3 different maximum out of pocket limits above the deductible. And so they basically allowed them to create that. And after they did that, they had 48 set of plans. Well, we got access to sort of understanding the menu and also got data on who chose what and their eventual medical spending. And what we found in this menu, that when they created this menu, of these, it generated 48 possible plans people could choose from. Essentially, every plan that did not have one of the high deductible levels, the $1,000 deductible, any plan with a 750, 500, or 250 deductible, um, in that firm had was dominated by an equivalent plan that was the same on all dimensions but had the $1,000 deductible. And it was basically the trade-off that I was showing you on the prior screen. That was one set of 4 plans you might look at with different deductibles holding everything else fixed. And, and so in this company, what we found is that the average employee could save $500 a year with a higher deductible with no chance of losing money if they chose that. So that was kind of one, like the deepest example we had of like, okay, we can really see this is happening, but it's still just kind of one example. So in a more recent study that's forthcoming now with my former graduate student, Chenyuan Liu, who's now at Tsinghua University in China, we looked at data from the Kaiser Family Foundation. So every year they survey a big survey of employers and ask them about their health benefits. So you may, for instance, see these news reports about what the average deductible looks like or sort of what the premiums are costing employees. And so we got the underlying data from that. And what we could see is there are a bunch of firms where we could actually do a bit of a comparison because they offer both a sort of standard coverage option and a formal high deductible option. So, and in this case, those high deductible options have to meet some federal minimums to be classified as a high deductible option that's eligible for a health savings account. And so at the firms that offered that choice, they had both a kind of non-high deductible and a high deductible option. We could look at the details of the features of those 2 plans. And what we found by doing a comparison similar to what I was showing you on the last page was that the high deductible option would be dominant for all employees at 37% of firms. So at about a third of firms that are offering both of these options, it's dominant. And we found actually that at more than half the firms, it would be really hard, though maybe not impossible, to rationalize choosing choosing a low deductible option. So, this 37% is the cases where it's just strict, like as soon as you do the math, for sure you're going to save. But at a lot more, the high deductible is almost surely the financially better option in terms of total spending for the year for the vast majority of people, and maybe everybody. And what we find is that at firms with this dominant high deductible option, the average employee would save over $1,000 a year by choosing that option. And again, without really any risk of needing to spend more. And finally, I'll just mention there's also a very recent study that's forthcoming by Abeluk and Gruber, where they were looking at the health insurance programs for school district employees in Oregon. And what they were finding was that many districts have big menus of options that include, and often these are similar to what I was showing you here, where they have a single insurer that has kind of an established network. And that insurer will offer like 5 or 6 different cost sharing variations that these school districts offer their employees. And what Ablock and Gruber find is they aren't spotting true dominance cases where it's easy to just say for sure you'd save money with one. But they're finding that if you really crunch the numbers and look at varieties of health risk, that in a lot of these districts that have really big menus, some of the options on those menus are really low value for the vast majority of employees, and that the average employee would tend to save about $600 by switching plans to a lower cost plan. So we see this is happening a lot. And then we could ask this question, well, do people actually choose these? And in both of my own studies, the answer is yes. So for instance, at that large employer that we got data from that made this switch, we found that 63% of people ended up enrolled in a dominated option. Similarly, in the paper forthcoming with Chen-Yuen Liu, the Kaiser Family Foundation doesn't give us micro level data on choices, but it does report for each plan for each employer what share of employees are enrolled in that plan. And what we find is that at firms with a dominant high deductible option, the majority of employees are still enrolled in the dominated lower deductible options. So we can see everywhere we've been able to see it, it looks pretty common that, when these things are offered, a sizable chunk of the population ends up choosing dominated options. Okay, so that's sort of just there. Then if you ask who chooses them, well, the who chooses them is actually pretty interesting. So first I can kind of show you this graph here, and then you can see in blue a few other things. But in the graph, what I'm showing you is from that company that we got the data from for the original study. uh, we had salary data, kind of binned midpoints of salary range. And the nice thing at this company was that they had some very low salary folks. These are people working kind of like retail sort of outlets, to some back office high-end professionals with professional degrees making more like $100,000 a year. And what you can see is that the lower income employees were more likely to be in these dominated options. So they were more likely to select one of the lower deductibles and be sort of paying more than they had to for a year. The other interesting thing, though, that you'll notice here is that across the wide spectrum of income, lots of people are doing this. So even amongst the most highly paid sort of professional workers at the company, it was still, 35% of them or so were making this choice. So it's sort of relatively common in general, but more common at this company among the lower income employees. But we also found it was more common for older employees and for those with pre-existing conditions and for female employees. So basically every category that's predictive of needing more healthcare was also predictive of paying more for insurance and choosing one of these dominated options.
Justin, can I ask just a quick process question? What do you
Sure.
know about how the people actually chose? They just got a packet of stuff and said, go off on your own? Is there an HR department? Does anyone help you do this, or just go?
Yeah. So I think it varies a ton and has been evolving at a lot of companies. At this company, when we studied them, they basically had a web portal that was part of their new sort of health insurance offering. So it was, fall, they did their open enrollment, they had a web portal. Everybody got some baseline introduction because everyone at the company had to switch into these new plans. They got rid of their old insurance plans. And so this whole platform was new. And so there was some information people could get about the plans, about other things, but the actual enrollment interface was not particularly sophisticated. It basically showed them choices for their deductible, and it would describe what does the deductible mean, showed them possibilities for their different plan features. You choose them all, and then it would allow you, it would show you that sort of thing, and it would ask you, okay, do you want to construct another option and make a comparison? And if you did that, it would then show them to you side by side, kind of like if you're shopping at Amazon and down below, it'll show you, that kind of two columns comparing things, or if you're shopping on like an auto website. But it's basically just showing you comparisons of deductibles and premiums and everything else in kind of a table format. Increasingly, I think the ecosystem of employee benefits includes more decision aid possibilities. There's a number of companies now trying to offer some tools to help people make some financial comparisons. There's been a little bit of work on those, and I think many of them are sort of potentially helpful with these sort of situations. But I think there's kind of two things that I've seen. One, they're often not very well embedded within the enrollment apparatus. Um, Two, they sometimes are fairly cumbersome to use because they're basically built to take in lots of information about you. But that means you've got to type in a bunch of information about your health status, maybe your kid's health status. And so I think people find them exhausting and tedious to try to even get the help. And then maybe kind of the third thing is even when they do show you things, we've had one of these at Wisconsin. So at the state system in Wisconsin, we have a dominant high deductible option. Um, and if you go through the decision aid you can get for us, uh, no matter what you do, it'll tell you you'll save money with the high deductible option. So the decision aid gets it right. But what they get at the HR people, the feedback they get is that people find this thing annoying because it always seems to just be recommending the high deductible option. And so they feel like this tool was designed with some ulterior motive to push them to the high deductible option. So I think there's a little bit of an issue too of like, how do you transparently show people information for a complex financial product such that they can actually trust what they're seeing? And maybe we can come back to that a little bit at the end too. Cool. Um, yep. So Walter had in the chat there, older employees choose the lower deductible, and that's exactly right. The older employees end up lower deductible. And I think for some pretty seemingly rational reasons, right? They know that they're probably going to have higher healthcare costs. They're probably also very used to having lower deductibles, right? They started having health insurance in environments where that was kind of the norm. Um, and so as we think about, okay, well, why are people choosing what they choose? I think the first thing to recognize here is that for most people, this is not a fully informed choice. So, and we know this in a couple of different ways. So one piece that I think is kind of interesting is that Eric Johnson and some co-authors, Eric's a really well-renowned psychologist from Columbia, um, is did a number of studies, and they've done studies where they give people kind of menus and try to track not only what they choose, but also try to use some process information to see what they're looking at. And so you can do this by designing platforms where somebody has to hover a mouse over things to see stuff, and then you can see what they're looking at. Or you can do this with eye tracking software where you have people sort of look at things and you have a camera tracking where their eyes go on the screen. And what they find basically is that when people compare options, they compare them down a column. Okay, so they'll look like at the premiums here and they'll say, okay, well, what's A's premium, what's B's, what's C's, what's D's? Or maybe they'll look at this column and they'll say, okay, let me look at this column. But if you were an economist and trying to figure out how should I absorb this option, you should actually be going across the rows a lot. You should be trying to add things up. You should be trying to say, okay, well, I know I'm going to pay this, but then there's some distribution where I might have to pay more. I might have to pay up to this much more. So I should add these things and I should combine it. And it looks like people aren't trying to do that. And then I've run a couple of experiments, both in that 2017 paper and in a newer paper I'll tell you a little bit about, where we've been able to find that essentially if you can make the dominance really transparent for people, if you can do the math for them and sort of show them that you'll spend more for sure, the vast majority of people then tell you they would choose the dominant option. So that's kind of an indicator that there's sort of a failure to really understand this that's partly behind it, that it's not necessarily reflecting a true preference. I'll come back to that in one second. I think there are some preferences that also point in this direction. What it appears to us that people really do, so I've got a paper with Anya Samek where what we did, and I'll tell you a little bit more about this paper because it gets into a decision aid that I want to talk to at the end. But what we did is we basically gave people, we asked people to choose from 10 different pairs of options. And so this was a hypothetical survey experiment, but with a pretty representative collection of adults who have health insurance from an employer. And so we sort of said, okay, first consider this pair. What would you choose? Then consider this pair. We had them do 10 of them. And these 10 pairs had very different features. Sometimes the high deductible was clearly dominant, but sometimes there was sort of a trade-off. And sometimes actually the low deductible was maybe pretty attractive. And then what we did is we tried to say, okay, let's think of some different simple models of what people might be doing and ask, okay, for a given individual, which kind of model of choosing things seems to best fit your 10 different choices we just saw? And what we found was that about half of people seemed like they could be best fit by very simple heuristics. And in particular, it looked like about half of people were always choosing the thing with either minimum out-of-pocket spending or the thing with the minimum deductible. So about half the people looked like they were looking at one of these two columns and sort of picking. And then there was a sizable share of people who looked roughly like they were mostly paying attention to premiums. And then there was a collection of people who looked like, they might be trying to do some sort of trade-off. They might be kind of trying to compare this versus this, and they were doing some switching in a way that, maybe not like a perfect economic model of this trade-off, but, was roughly consistent with the way economists would write down some utility maximizing model. So you kind of had this mix of people. But in particular, among these people who are using kind of a simple heuristic where they're just kind of looking at one of these options, it was more common that those were people with higher medical spending. So basically, I think my dominant model of this is that there's a bunch of people who know that health insurance is confusing, and they look at this and they say, look, I'm not 100% sure how to parse this, but I know I'm a high risk person. So I know I'm going to spend a lot. So I'm going to focus on the spending features of the contract more than I'm going to pay attention to the premium. And so they kind of isolate mostly on one of those dimensions. And I think that's a big piece of how people are ended up in these dominated options. The last thing I'll say though is that there is also a smaller subset of people where choosing these dominated options may reflect a rational response to, in some way, to liquidity type problems. So the thing is, I've told you that the high deductible dominates financially. It does so by the time the year is over, okay? So by that, I mean, for the year, you're definitely going to end up spending more if you choose one of these plans than if you choose plan D. But if you think about January, right? Think about the beginning of the year. Well, in the beginning of the year, at most employers, you've only had to pay part of the premium. You're paying some of this out of your paychecks, but you could get hit with a surgery right away in January and have a $3,500 bill. Now, by the time the year's over, you will have made up the additional money through your premium savings, but it might not happen right away. So it could be that for people who are really sensitive to higher cost shocks, and we know there's a large fraction of people in the US, for instance, who have a lot of struggles making ends meet and live very kind of cash on hand, it could be that there's sort of a semi-rational process here of essentially using the fact that your employer will let you pay for this over the course of the year through premiums as kind of a way of financing healthcare costs. I have a paper on this kind of idea of liquidity and insurance with Keith Erickson, and we did a survey related to this. And what I would say is that I think this is an issue for a relatively smaller subset of people. It's not very common that I think somebody is so willing to do this that they would actually completely violate dominance. But there's a core of people who report having a lot of trouble making ends meet, who do also tell you that they find an argument in favor of paying more for sure for the year, but being able to spread it out in premiums rather than being exposed to high out-of-pocket costs attractive. So we see some evidence that there's a little bit of that argument going on as well. Okay, so my kind of dominant themes here are Why do people do this? I think largely they're sort of using simple heuristics that line up with if they're going to have a lot of medical costs, they probably want good coverage, where that good coverage isn't fully taking into account the cost, the premium for it. Probably because it's a little bit hard to think about how to compare these things. All these numbers kind of overwhelm people. And there's a smaller set who are just really averse to these high out-of-pocket costs and maybe even are kind of semi-rationally or sort of semi-willing to, even if informed, to pay a lot to avoid being in that situation. Okay, so that's kind of, sort of first parts. It's common. A lot of people are choosing it, especially those with high costs. And as Jake is saying here, it's expensive to be poor, right? And there is a lot of work on that, right? That, this is another example of, to the extent that somebody was semi-rationally choosing this choice because they couldn't absorb these short-term high out-of-pocket costs. It's another example of that high cost of being poor, right? Um, so why would employers, I think this is kind of the most interesting question, why would employers have health insurance options with dominated options? Why would you create a menu and have some options that are just really hard to rationalize? Um, so I think there are a number of potential stories here, but I think there's kind of an underlying dominant option. Dominant, I'm using the word dominant too much here. I think there's an underlying story that explains a lot of what's going on here and how this happens. And so I want to illustrate it, and this may be sort of oversimplified for many of you who are familiar with these concepts of adverse selection, but it might be a little bit fun anyway. So I'm going to illustrate this with some sort of cartoon figures, but basically I'm going to tell you a story about adverse selection and how adverse selection, if passed through once you create a menu with options, can create these sort of dominant option situations. So here's kind of my story. What I want you to imagine is, suppose we've got a population of our employees that vary in their health. So some are less healthy, some are more healthy, and they vary a bit on their risk attitudes. Some of them are more risk averse. They generally don't want a lot of financial fluctuations. Some are less risk averse. So I'm going to populate these. We've got Homer. He's kind of less healthy and risk averse. And then we've got our other guys, more healthy, still risk averse, more healthy and less risk averse, and then less healthy and less risk averse. Okay. Now, what we should think about is, if we're thinking about healthcare costs, dominant thing is that our less healthy guys here are pretty high expected medical costs. So we could say on average, they're going to cost $9,500 a year. And that's probably actually a low estimate for people who are, high healthcare costs these days. Now, of course, it's not, we wouldn't need insurance if we knew for sure it would be $9,500. The issue is that, it could turn out to be less or it could turn out to be way more, but on average, it might be about 9,500. Now, for the two guys on the bottom, their expected medical costs are quite a bit lower, half as much, $4,500 for the year. And in a lot of years, they might be close to zero. Some years they need a surgery and they're higher, so on average. So we see there's this big $5,000 wedge between these sort of parts of our population. Now, if we pool them together, so as an employee group as a whole, their average yearly medical costs are $7,000. So I'm just taking the average of those two numbers. Okay, so we've got a population that on average has $7,000 worth of medical bills. And we're trying to devise health insurance for them. So now let's think about a world in which we either offer a standard plan, and so I call this standard, but this was sort of standard, at least for like government employees, it still might be close to standard, and it was standard for people with good insurance maybe 20 years ago, right? You'd have this low deductible, $250 deductible. So basically most of your health spending's covered. It's sort of a generous plan. If they design that plan for everybody, what you can say is almost all of the health spending, which remember on average is about $7,000, is going to be covered. So the premium, the total cost for that insurance plan would be about $7,000. Okay? And that'll be the cost if we try to buy it from an insurance company, or it would be the amount of money that the employer would set aside if they were being self-insured and sort of administering this. They would still have to set aside about $7,000 a year for every employee to create kind of the pool to pay for stuff. All right. If we go with the higher deductible plan, Well, and of course the distribution of spending here matters exactly, but roughly about $2,000 worth is going to be paid out of pocket by the employees. So we could say maybe this plan would end up having a premium of about 5,000. Okay, and so we've got, two different plans. It's not clear that one is obviously better than the other. The top one costs more, but you're also getting more coverage equivalently, and so on. Now, suppose we offer both of these options to our employees. If they sort on their risk aversion, so if basically we get mostly it's risk aversion that they sort by, then each plan is going to attract a group, both less healthy and more healthy. And so in each plan, you'll have a bunch of people that have $7,000 of average medical bills because you're kind of mixing healthy and unhealthy. And the prices for these plans will end up being reflecting just what they would look like if we gave that plan to everybody. Okay. But, and here's the key thing, remember, we saw that what actually it looks like people are doing is they're largely sorting on their health risk. So, people who know that they're more likely to need medical coverage are more likely to choose the high generosity plan, the sort of low deductible plan. And those who know that they're not going to need much are like, well, I can take the high deductible and save some money on premium. Now, when they sort in this way, when you get a sort of big differential, in my little toy example here, what do we end up with? Well, we end up with the average medical bills in this plan are $9,500. The average medical bills in this plan are $5,000 less because it's attracted all the healthy people. And so if we price the premium for the plan, if we say, okay, well, what's the premium to cover the people in this plan? We're going to get this massive differential because we're going to have this $9,500 premium, basically a plan that's giving full coverage to a bunch of really high cost people. And in this case, we're going to have a plan that's much, much cheaper. In this example, $7,000 cheaper because it's attracting healthy people and it's only paying part of their medical bills. So now notice, if you look at that and you say, okay, if we set up that menu, in theory, the light would go on for these guys if they have a choice and they say, oh, well, wait, you're telling me I could pay $7,000 less to take a $2,000 higher deductible. We would hope they'd spot that. And if they did, what would end up happening is everybody would choose that plan. But now if everybody chose it, this premium wouldn't be the final premium. It would actually come back up because now we'd be getting the whole population in it and we'd be back to the situation we had if we only offered that plan. Okay, so it's kind of my little like toy adverse selection model, and this kind of model of adverse selection unraveling. But there's also, when we think about kind of the behavioral economics of this, and in particular, if we think about a world in which it's not quite this stark, where we don't get a full separation of all of our least healthy and all of our most healthy employees, but we generally get this kind of tension where the plans have come to reflect the health risk of the people in the plan. If people don't spot it, if it's confusing and hard to notice the difference, then you could persist with these very large differentials that aren't warranted by the coverage, but are really reflecting the fact that rather than getting to pool with these healthier folks and hold down their cost, these less healthy folks are now pretty much paying more directly for their healthcare costs. They've sort of pooled together with a subset of the employees. Okay. So I think that is sort of the number one explanation for what's going on here. I think employers have started to create menus with options. And I think there's a variety of reasons that employers might create options. I think some of this is kind of sold to them by brokers and benefit consultants who tell them, oh, we can create options. People love choice. Some people really believe heavily in giving people financial choice and don't want to have to make those decisions. So if you're working in the sort of benefits group at a large employer, you'll have some people who tell you they really don't want to pay a lot for insurance. And you'll have some people who are going to tell you that they really hate high deductibles and you can't make them all happy. And so if your broker comes and says, well, you could set up options, let people choose which one they want, you maybe feel okay about that. And so I think as they do that, though, you get this kind of sorting, this natural sorting by health risk. And the standard way that premiums are set is based on this very simple actuarial practice of setting the premiums based on the health risk of that plan. And so I think there's this feedback loop of selection then leads to higher cost differences. Now, employers in principle could control the final thing that employees see. So just because on this prior screen, we have these big premium differentials that we have to set aside, it doesn't necessarily mean that these are the costs they have to give to the employees. The employers can do their own contributions and set what the required contribution for the employee is. But in practice, it appears, and I'll show you a little evidence on the next screen, that what many employers do is that they roughly just pick a contribution amount for the benefits. They say, we're going to put $5,000 towards each employee's benefits, and we're going to put that towards the benefits regardless of which of our health insurance plans you're in. So it's sort of seemingly fair in that way. And then what ends up happening is that you've got these plans that are very high cost because they've attracted mostly your less healthy people, and these plans that are very low cost because they've attracted mostly your healthier people. Uh, and the employer pays an equal dollar amount towards each plan. The residual then means that the employees are sort of bearing that breakdown in the risk pooling. In a lot of cases, I think employers may not understand this dynamic themselves. So at that Fortune 500 company that we initially got data from, we did this analysis, and then my co-authors presented the results to the CFO of the company, sort of showing that there are these big cost differentials and that they had this pattern where their lower income and higher health risk and older employees were selecting those high cost options. And pretty quickly, within a year or two, the company actually ditched this plan and went away from offering choice, and they just moved everybody to a high deductible plan. And so I think that was an example where the company was not trying to necessarily create this dynamic. They didn't fully appreciate, I think, this kind of adverse selection economics playing out within their system. Now, that said, so this is what I call kind of a simple pass-through story. And I think there is a lot of this, that there's sort of an adverse selection pass-through. There's also some reasons that employers may be creating options and doing it in a way that favors the high deductible option, or sort of favors the people who select into these high deductible options. And there's a couple of different reasons and like incentives an employer might have for wanting to do that. So they may be trying to drive down overall healthcare costs, and they feel like switching people to high deductibles will cause them to use less care. So a sort of moral hazard story. And that they may not want to force everybody right away. They might want to socialize it. So they're trying to create an incentive towards that. So making it very low cost. They may also want to offer better benefits to younger, healthier employers. Um, Now, there's a variety of reasons in the labor market that employers might want to be able to do that, and are typically somewhat limited in their ability to offer better benefits based on an employee's health status or their age. But this sort of health insurance choice mechanism is roughly one way to do that. And in particular, if you make the premiums especially low for high deductible plans, or give generous contributions to a health savings account, you may be able to create that sort of dynamic. In the study I mentioned, where we used the Kaiser Family Foundation data, we found some evidence consistent, especially with this simple pass-through of adverse selection story, but also some evidence in favor of this favoring of the other option, favoring the high deductible option. So this is a histogram of across the companies that were offering a high deductible and a low deductible option, of the total firm contribution to the plans, meaning what is the total amount of money the company is spending for a person enrolled in one of these plans, through the company's payment for the health insurance premium, and potentially for the high deductible option, the amount the company was giving employees as a health savings account contribution. And what you can see here is there's a big spike right at zero. So this means the most common single thing that companies were doing was giving exactly the same amount of money to both plans. Even though typically at these plans, the premium differences between their plans were clearly reflecting population differences because they were way too big to be explained by the difference only in the coverage between those plans. But there is also a little bit of excess mass on the right of this graph, and that is sort of evidence in favor of some companies are, especially through their HSA contributions, kind of giving a bit of a boost to somebody and giving slightly higher total benefits to people who choose the high deductible options. All right. So that's kind of my story for sort of where is this coming from. And then why don't I hit quickly here on sort of what might we do about this? How might we think about regulation and decision aids? And then we can have a little time for some questions and more discussion. Um, so when we think about the kind of what can we do, I think there's a couple of things. First, I think for employers, as we get more research on this and start to understand what's going on, I think actually there's a reasonable thing to sort of push to employers to rethink whether offering options is a good idea. I think what this research is sort of showing is that the act of trying to put options into your health insurance program puts a tension on risk pooling. Okay, so you're going to tend to get, higher risk and lower risk people wanting different options. And we know also that choosing health insurance is a really hard thing for most people. It's financially complicated, and most people don't like making the choice. So fundamentally, when you're offering options, you're kind of creating almost a false option, because what you're really doing is creating this tension about risk pooling, and you're not fundamentally solving the really hard problem. And I think the really hard problem is that employer sponsored insurance right now is typically about having a pooled risk. And we have to make a decision about, well, how generous are the benefits for that pooled risk going to be? Are they going to be, high generosity benefits and then incumbent on that lower wages, or lower generosity benefits? And so I think choice of health insurance coverage amounts is maybe not the best tool for trying to resolve some of that tension. I think for regulators, there's an interesting difference when we compare the employer-sponsored world to what we see in situations like the ACA private exchanges that were set up. So in the ACA private exchanges, actually, in very recent years, there's some examples where you can find dominated options. And they've largely come from kind of a breakdown in the original regulatory structure. So basically, after the prior administration, after the Trump administration, removed government payments for what are called the cost sharing reductions, you got some distortions in these markets. And there's been some nice work by a guy named Dave Anderson and some colleagues, Dave's at Duke, that has looked at this, and you see this. But for the most part, the ACA has operated without having these dominated options. And the main reason is that there's a whole bunch of regulations in place to support community rating in the ACA, to support this risk pooling, where basically they were aware when they set up these exchanges that if we have exchanges that allow some people to choose generous coverage and some people to choose less generous coverage, that there's going to be this tension created of this kind of adverse selection process that's going to cause potential divergence in premiums and an unraveling of this sort of risk pooling. And so they have a number of sort of actuarial rules and risk transfer rules in place to try to limit the extent to which you can get these sort of big divergences. But there's not a similar regulation that I've been able to find in the employer-sponsored insurance realm. So there's no real guidance to employers about how, if they're going to offer these options, in particular, how are the prices? Now, the employers can't just give different insurance to people based on whether or not they're good health or not good health. Other than a little bit of limits around, the ACA allows some differential pricing for smoking status, for instance. But there's some fairly simple regulations you could do. It could be that you could require premiums in employer-sponsored insurance to be based on the full employee population, not those who choose the plan. So that's roughly what the ACA regulation is. It says you have to give me an entire population and then price each plan as though all of the people enrolled in that plan. That basically forces the cost for the the more generous plan to reflect a mix of high cost and low cost, and similar for the high deductible plan. So it helps to equalize the plan costs. So that's potentially a type of regulation that could limit the scope for employers offering options and having it end up with these kind of dominated situations. And then the last thing that we could think about here is, to the extent that choice is going to happen, and to the extent that there's not going to be an immediate switch to new regulations, it likely is going to be helpful to develop better decision aids that help people, but also help like the benefit administrators who are setting up these menus of options better understand the consequences. We can see that this kind of standard way of just presenting people features is not really working. Most people can't or don't sort of add things up and make the comparisons they need. I think we've learned a few things. There's been a couple of studies trying to look at some of these things. One is that it really needs to be embedded in the choice process. So it looks like people do not seek these sort of decision aids that exist now. They don't really seek them out at high rates. And so, for instance, in the Wisconsin system, I told you we have a dominant option. We also have a decision aid. It'll tell you to choose the dominant option, as I was talking about before. Very few people actually use the decision aid tool. They just sort of select their plan. And I think part of that is just user design issues, making it easy to see. But it's sort of just not a natural part of the process. It's like an additional barrier. And so if people don't fully have an appreciation for how costly this might be, they may underuse decision aids. They also need to be pretty easy to process. So if the decision aid is complex, people are pretty likely to fall back on simple heuristics. And I think they need to help people process risk and trade-offs. So when people are choosing insurance, they know that there's not a simple answer, right? They sort of know that, well, depends what happens to me, how much I'm going to spend. Unless the decision tool does a fairly good job of showing them that, I think they're less likely to follow it. And in fact, I have some data and some information on this. With Anya Samak, we've developed a kind of decision aid approach that tries to sort of graphically show people the consequences of different options based on their health risk. And we've tested that, and we can show that doing this kind of graphical display leads people to make big shifts in what they say they would change, and they are much less likely to choose a dominated option. But we also compared that to simpler things, like just telling people their expected amount of money they'd spend. And we found actually that the simple tell people on average what are you going to spend in these plans does a lot less to move their choice shares and does a lot less to pull them away from simple heuristics. And our explanation for that is that people don't fully trust or believe that expected value calculation because they know that there's more behind it. And so I think to some extent there's a trick here that this is a place that should be ripe for a decision aid, but building one that people will access and understand and that shows them enough information that they can trust it is a challenge. And I think we're making some ground there, but it's not ubiquitous in the market. Okay, so I've got a couple of slides I can show you what that decision aid tool thing looks like that we've been working on, but I'd like to cut it off here and kind of give some time for some questions or further discussions.
Great, thank you so much. That was amazing. And I don't know, I have lots of things I'd like to ask you about, but I'll yield to anybody else who wants to take the floor. So you can use me as a last resort. Anybody?
We got one hand up there.
Okay,
Let's
go
see,
for it.
Josh, yeah.
Justin, thanks. I really appreciate you joining this group to present to us. I've always been a long admirer of your work.
And I have yours, Josh. I like your stuff.
Just a couple questions. So one, I think Peter's question way back when, I do think that's critically important to know, which is often very hard, if not impossible, to know sort of, exactly how options are presented to people. As you know, the burgeoning literature, which I've dipped my toe into, and limited consideration, the idea that these choice sets can be massaged for you, choice architectured for you, and that sometimes things like observing people choosing dominated options, maybe that could be behind it. But so I agree that that's an important question. But I also want to talk your community rating points. I guess I understand how some of your suggestions here, right on the slide that's still up, can deal with the idea of sort of adverse selection that can go on within the menus.
Yep.
But can it deal with the problem of people just not buying the insurance at all? In other words, so, if you're
Yep.
in a family, you don't buy this insurance, but you buy your spouse's insurance. And so you still
Yeah.
can get adverse selection
Yeah,
that
so
way.
I think that's a good point. I don't think it could, right? So this would definitely be within your employee population who is selecting from your plans.
Yeah.
You could guarantee that your plan menu doesn't start to reflect these sort of differentials, but there could still definitely be like a cross-employer
Yeah.
adverse selection problems here, right? And I think almost surely some of that is starting to emerge also as employers have started to have more diversity in the sort of health insurance options they're offering, right? We still have some, especially those of us in, public employment often are in pretty generous, fully insured type plans. And some of the private market has sort of gone way in the other direction. And as that sort of divergence happens and people have some choice across family units of which insurer to get, I think for sure we're seeing some of that. I haven't actually seen somebody study it or try to document how much that's going on. That's an interesting point. And it could actually, there's probably certain markets with like really dominant public sector employment, like I think in Madison here, right, where we've got the university that's kind of a dominant employer, where there actually could be something pretty interesting going on with
For the
that.
federal government here.
Yeah, exactly.
But so that just pushes me to sort of your last set of bullet points that maybe that's more promising. And so I guess
Yep.
in my mind, it would be you'd want some regulatory oversight about those menus, about not having dominated options, but also making sure that people don't get curated menus, that they're helped to understand the real economics of the options and to see the full menus rather than have, an agent or HR person tell them, look, you're a this type of person, so you should be getting
Right.
this option or that option.
Yep. Well, and I do think, I think there's a lot of promise these days. We were talking a little, I think, before everybody joined, that there's, a number of companies, kind of startup companies in this space of trying to offer decision aids around these things. And I think there's a lot of power that they can bring in that it's increasingly possible to use sort of embedded data on health costs to do a pretty good projection for people of different costs. And as people get creative of exploring different ways of showing it, I think then the key thing is trying to figure out how do we monitor and watch that whatever company or agency is engaged in that process is doing it in a way that's not sort of pushing people towards some options versus others. I think that's right. And it sort of just creates that slightly different spot where we need some sort of monitoring.
Thanks a lot.
Yeah.
Guards the guardians, as we like to say in law school.
I don't have the hand up. Can I ask a question?
Yeah, sure.
Yeah. So, if you've been at this a long time, the idea of decision aids and understanding the economics always sounds good, but people don't really like it. So my background comes 30 years ago, all of the insurance companies authored health insurance, almost all the major ones. It was one plan for the employer. There were no choices, and the employees loved it because they didn't have to think about it. It was just, okay, you get health insurance.
Yep.
And then the employers moved to saying, we're going to put a financial contribution and we're going to give employees choice because we don't want to pick the plan. But I think about the decision aids, and really a much simpler place was looking at the 401k plans before auto enrollment. HR department said, if we sit people down for an hour when they're hired, we'll explain to them how good a 401k plan is. They will all look up and at the end, leave the room and check a box and say, we will do it. But in fact, they never, or most of them never enroll. So auto enrollment flipped it to change the way so you didn't have these decision trees. Of course, the decisions they make about where the 401k money goes is another issue they need more information on. But it's really hard to move people with this economics. You and I, or some of us, can talk about it, but most people just want to sign the paper and get away from the discussion. So that's maybe a single plan may be the right way of doing it,
Yeah, I agree with that, sort of all of what you just said there, that, I think I'm doing some work on decision aids, partly because I think, you know, it's kind of a reality right now that we're putting people in a lot of choice environments. But at the root, actually, I've done some other work where it's hard to actually see what the big benefit of offering options might be. So in a kind of on average sense, giving the options doesn't help people a lot unless there's a huge variation in people's tolerance for risk. But it seems like in this space that it's not really risk tolerance that separates most of us that much. What separates us is, financial sophistication or health risk, but not sort of risk tolerance. And so in that world, I do think that probably the best recommendation would be trying to get back to a situation where we don't give a lot of options. Now, maybe we do want some options across some different providers of, sort of provider networks. So I think there's some different arguments about whether you might want to be able to choose, which hospital network your insurer is giving you access to. But in terms of these financial features, I think eliminating the choice makes a lot of sense. I think fundamentally it helps to highlight that there's just this more general tension that as healthcare costs have risen a lot, as a society of people sort of working, and we see this I think on all dimensions of health insurance, whether it's the public stuff or the employer sponsored stuff, we just kind of have some fundamental disagreements about how generous the insurance coverage should be. And those line up on sort of natural dimensions, right? People who are really young at the moment and good health risk, and especially think they're always going to be good health risk, um, likely sort of want a world where we don't have that much coverage, and people are responsible for paying the residual, and many other people want the reverse. And so I think options seem attractive initially because it seems like we can let people make these choices, but sort of the fundamental economics of the selection problems and the adverse selection undermines that, and we're sort of back to this debate. And so I think the nice comparison here is, suppose that somebody sees our study and then they say, okay, I see these dominated options are a problem. Let's get rid of choice. They're then back in this dilemma. So which of these two things should I offer, right? Should I offer the low deductible or the high deductible? And you're going to have the population kind of split on which of those two things you want to do.
Thank you.
Okay, it's after 5, and so any student is free to disappear at this point, and of course the audience was always free to disappear, but Justin's agreed to stick around for a little bit longer, so anyone who's interested is welcome to do that as well. But thanks again. So Justin, is it your sense that maybe the variance of health spending has increased too, and that's put additional pressure on this? Because like you think like a given operation, a gallbladder or something like that now costs a lot more. So if you have one of those, it's going to be a big bill, and if you don't, you save it. And that doesn't that put additional tension on all this?
Yeah, I think it has. I haven't studied a lot the sort of evolution of cost, but my understanding is that, as the costs have risen, that it's sort of, both the mean and the variance are increasing over time.
Yeah.
And I do think that does create additional tension here, right? Because you just have a lot of people who are spending very little and saving a lot with the high deductible options. And then you have these other people who are basically for sure hitting the maximum out of pocket with pretty high likelihoods. And so I think you create that tension. I do think for some of these like calculations of the dominance, though, precisely because almost all these plans have relatively low maximum out of pocket limits, that the kind of math or the tension on this kind of domination thing doesn't tend to change hugely over time, in that, if I increase the variance on the upper end, it's all just over the out of pocket limit. So it doesn't create that much difference there.
Who else? A student wrote a great reaction paper in which she's going to be too shy, so I won't even mention her name. But she asked me, she asked, what do we know about real experts? Like, has anyone tried to study the decision about healthcare planning for HR, senior HR professionals or whatever? Do even they get it right? Do you know if anybody who's done work on that? Like, what do the real experts do?
Yeah, so I haven't seen.
Or like the
So-
Wisconsin Economics Department or something.
Yeah. So I haven't seen any like a good study on it. I can tell you anecdotally that my colleagues, and hopefully they won't watch this this recording, but my colleagues in the risk and insurance department at UW-Madison, when we first got our high deductible option at UW, and it was not quite dominant in the first year and was clearly dominant in the second year on when they started giving more money towards it. I was the only one who was choosing the high deductible originally. I had to kind of do this work and convince them all that it was the right thing to do. And I think it was partly, I'm sure they could have gotten it had they decided to put the effort in. But I think they all were kind of comfortable with what they'd been having, and there wasn't a change to their old plan. So this was partly an inertia story. So I don't know that my hunch would be that if you looked at real experts in terms of health insurance, that most of them would be able to get it. But I think even among like the benefit managers at these large companies, I think many of them are not actually particularly sophisticated about health insurance. So I actually got invited few years ago to give a talk at a group that was basically a group of the sort of employee benefit managers for certain types of companies. And I was able to talk to them about some of these things, and it was clear that for the vast majority of them, I was teaching them a lot about how these things might be priced or sort of how the adverse selection might play out. So I think for a lot of them, health insurance is as confusing as it is for anybody else. But it is a nice idea. It would be interesting to see what happens more generally when you try to study a large group of experts or seeming experts on these things.
Okay, who else? Anybody?
Better to pay high premium, even though you're paying more, than run the risk. So Jeff's asking a question in the chat about this kind of liquidity value, even for high income people. My answer to that is I think there's kind of a divergence between what I would call like the true liquidity value and kind of the way people act. And so what I would say is the true liquidity value, I think, is pretty low from this. Like, so if you thought about the liquidity value, the idea is that I pay a lot for insurance every month in a monthly payment, and then I don't get hit with large shocks potentially. I think most higher income people, even if they sort of feel like they're sort of living pretty lean and they're pretty leveraged, actually have, if push came to shove, a fair amount of pretty low cost ways of financing $1,000 shock over the course of a year. In particular, like even just putting that on a credit card at 20% interest for a lot of people would be a better way to do that. But I do think there's a lot of people for whom what I would call kind of the pseudo liquidity value might be high, in that I think a lot of people have a kind of pain of paying for things. So they feel lumpy payments and shocks as a real shock. And I think there's, kind of a variety of psychological reasons kind of behind that. And so I think, people do actually dislike high deductibles. Like they don't find them pleasant over the course of a year. I think it's a little hard to know, if you force somebody to really think about the total amount they were paying to avoid that feeling, whether they really would want to make that trade-off. But there is something there, and it is something that makes me a little cautious. When I talk to people like at Wisconsin about these high deductible options, I try to make it clear what the underlying trade-off is. And then I often try to highlight to them, like, okay, so why might you choose this even after you talk to me? Why might you choose the lower deductible? And I talk a little bit about liquidity, and then I also talk about, and if you're the sort of person who just absolutely hates and gets super frustrated every time you get a medical bill that you have to pay out of pocket, maybe you want to do this, but you should just be really aware that by doing that, you're basically paying this money every month to avoid having that happen. And so if you understand that cost, I'd be okay if you were sort of willing to pay to dodge that. I see Maggie's got her hand up.
Hi, thank you. Yeah. I just had a question about like kind of tied to the liquidity. If you've noticed a difference in health outcomes and access to healthcare, like are people going to doctors or getting medical attention when they need it in differing rates based on which plan they have? Because like I know for me personally, I'm like, oh, I'm not going to see the doctor unless I'm dying because I don't want to pay a copay or pay up to my deductible or something like that. So do the different plans have different health outcomes for patients?
Yep. So I think that's a great question. I haven't done my own research on this, but there's sort of a parallel research as we've been doing this choice stuff. There's been a bunch of studies recently about sort of what happens when people end up in sort of higher deductible plans and are more generally exposed to a lot of cost sharing. And all of that research is pointing towards the direction that these sort of high cost sharing plans cause people to spend a lot less on healthcare and seem to do so in a pretty inefficient and blunt instrument sort of way. So you see people are avoiding what looks like quite valuable care when they have to pay a bunch of money out of pocket. So there's been a good study by Zarkbrook Goldberg and Ben Handel and John Kolstad and some co-authors where they looked at a company that switched everybody from a very generous kind of public sector type thing to everybody went to a high deductible, and they also gave people a lot of money into a health savings account so they could in principle pay for stuff. What they found was people really reduced their healthcare utilization, but that was also true even for people with like chronic diseases and stuff, and for what seemed like very high value care. It wasn't just low value care people are avoiding. There's also a recent paper out on seniors filling prescriptions, in particular very low income seniors, and what they were finding was that they tend to really fill their prescriptions on the days that they get their Social Security checks, even when they have what look like pretty modest copays, like $5 or $10. And that's even happening for certain drugs where it appears medically there should be a really big cost to potentially waiting 2 weeks to fill this drug may be a really big problem. And so I think there's a bunch of evidence consistent with what you're thinking here, Maggie, that like putting people in these high deductible options may be sort of bad for their health in some ways. And I think if you think about it in the context of this stuff, I don't think that's probably the dominant, like fully considered reason that people are choosing these low deductible options within these particular employer menus, in that I don't think they've basically done the math to themselves and said, hey, I'm going to spend $1,000 more a year if I choose this low deductible, even holding fixed my health spending. But I would, even if I saved that money, I would feel really bad and I wouldn't access the doctor well. So therefore, it's worth paying the extra money. I think if you put it to people like that, they would potentially think, maybe wrongly for themselves, that, oh, well, I can take this savings and I'll still just go to the doctor. I can ignore it. But I do think it's an important thing that, like, as we develop these decision aids that I'm talking about for choice, I think they also would need to be coupled with how do you get people to better use, if they're going to tell people that, well, given the choices they've set up, you probably should choose the high deductible plan. We also have to have a way of helping people understand, like, look, there's money set aside that you can use when you have a real valuable medical thing. You need to actually use that money and go. You need to not be so afraid of spending money on healthcare. But I do think it's a tricky issue that pops up and that we've started to wrestle with a little, especially in this kind of decision aid literature.
Thank you.
Okay, it's 5:15. I think we've detained Justin long enough. Thank you so much. That was really, like, it exceeded my incredibly high expectations. So thanks
Well,
for coming and for
thank
all
you,
that work.
everybody, for coming and for the really insightful and interesting questions and conversations. I enjoyed this a lot.
Great. See you again soon. Thank you.
Great.
Bye, Justin.
Thank you. Thanks,
Thank
Peter.
you.
Bye.
See ya.